Hello, this is Dale. I have released 15 trades for the month of July, with 12 of them being winners. Our website specializes in credit spreads. And what I'd like to do is just review two of the profitable credit spreads we had in the month of July. One was on the SPX weekly bull put, and the other was Amazon, a monthly bull put. The SPX we only had on for 2 days, and the monthly Amazon we had for 10 days. Both of them very profitable, and this is the kind of trading we do on a routine basis. We've got consistent profits, and we do very well. Again, my name is Dale Brethauer. I've been a trader for over 4 decades. Hedge fund manager. I've been a guest speaker on a number of platforms. I've written 3 financial books, and I am the founder of www.optionsinfinity.com, which I believe is the very best stock option education website available today. And like I said, we specialize in credit spreads. I happen to believe, after all my years of trading, that credit spreads are the most consistent way to earn monthly incomes. The advantages of vertical credit spreads is, like I said, you get great returns, and these are coupled with a high probability of success. Basically, what we're doing is, when we are setting up a vertical credit spread, either a bull put or a bear call, we are selling premium. We're selling the premium. So time is in our favor. Nice thing about credit spreads is you don't have to constantly watch the market. You don't have to watch the price bars going up and down. If you just check in every once in a while and see how your position is doing, that's good enough. It's a low anxiety trading. And when we set up a credit spread versus selling naked, we are protecting ourselves against losses. What we're doing is we're taking advantage of the rapid decay of theta, which happens in option premiums in the last 30 days. This especially, you can see from this chart, this especially drops off very rapidly in the last week, and that's where we take advantage of trading our SPX weeklies. Now, there are 2 vertical spreads. One is a bear call, one is a bull put. The bear call, the operative word there is bear. It's a bearish strategy. And basically what you're doing there is you are selling one out of the money, and then you're buying an option further out of the money for protection. With a bull put, it's a bullish strategy, and basically what you're doing is selling an out of the money put and then buying one further out of the money for protection. The first trade we had on that I want to show you today was a bull put spread on the SPX weekly. We got out in this trade on July 14th, got out the 16th, only 2 days, actually a day and a half later. The setup was we sold a bull put on the SPX, selling the 24 July 30/80 put for $20.75, and then buying one further out of the money, the 30/75 put at $19.80. That gave us a net credit of 95 cents. And a lot of people say, well, if you have a bullish strategy, why not just go ahead and sell this outright and collect all this premium? Highly risky to do that. They call that selling naked. And the floor traders will require a very large margin when people do that. And actually by buying protection here and setting up a vertical spread, the margin requirements are less. So the profit on a percent basis is actually just as good when you would just sell naked. So the difference between these two is 95 cents. Now, if we take a look at the chart here, what I've got here is the regression channel. The regression line is calculated by 50% of the price above, 50% of the price below. And then the green line is plus or minus 1 standard deviation, and the gold line is plus or minus 2. Statistically, 95% of all prices are contained within the plus or minus 2 channel. So when I see a trade getting out of that channel, I know it's going to revert back to the mean. A lot of times I'll get in right here, but sometimes I'll just wait for a measured move right here. A lot of this terminology might be new to you, but at the end of this video, I'm going to show you a way to connect up with my YouTube channel where I've got over 35 educational videos for you, and I can explain all these terms. I'm also going to take you to our website and show you how you can find out exactly how I do my trading. So this was the trade setup, and then a day and a half later, when we had a big rise here, and it went up to the 161 on the Fibonacci. That's another tool that I use. I try to keep things simple. We bought the bull put back, and we bought it back now for a net debit of a dime. And actually, let's see, it was actually 15 cents. It should have been 15 cents. So you take the 95 cents that we collected on credit minus what we bought it back for. So we had an 80 cents profit, or $80 for one contract. That's an 84% profit on credit. Now, this is just for one contract. If you had 10 contracts, that's an $800 profit. If you had 50 contracts, that's $4,000 profit. This is a very profitable strategy. Very, very low risk, protected, consistent, conservative trade. I need to mention to you that past performances are no guarantee of future results. I'm just showing you two examples of what we did in the month of July. The other one was a bull put spread on Amazon monthly. This one was we put on the beginning of the month, July 1, and took it off on July 10th. You can see once again we were looking for a measured move right here, and we got it right at this point here. And then I look at the Fibonacci's, and I was looking to get out right around the 161. The beautiful thing about the Fibonacci's is that you want to get out while the trade is going with you. You don't want to wait till it pulls back. So the way we set this up is I sold a July 2400 put and bought the July 2390 put for a net credit of $2.07. When we bought it back on July 10th, we bought now the 31 July 2400 and sold the 31 July 2390 put for a net debit of 45 cents. The difference between the 207 we collected minus what we bought it back for was a $1.62 profit, or $162 for one contract, which is once again a very high profit on the credit. Now this is just for one contract. If you had 10, it's 1620. If you had 50, it's 8,100. This is again a very conservative, very powerful trade when you couple it together with the regression channel and measured moves and Fibonacci's. Once again, past performances is no guarantee of future results. Now, since we put together the website back in November of 2009, we have sent out 732 trades to our members. These alerts are what I am doing. You have to look at that trade and decide if that's what you want to take. Over that period of time, 542 were winners, 190 losers, for 74% over a greater than 10-year period. This is just the equity curve over the last a year and a half from 2019 all the way through to the end of July here on 2020. And you can see that, yeah, we have some dips. This took a little dip here, the coronavirus scare. We have some losers. However, in the long run, this is the kind of equity curve that you can bank on. And this is something that I'm very proud of. And I'm to the point in my career where I get a big kick out of teaching people how to do and how to make money in a very difficult arena. Now, let me go ahead and close this out, and let me go ahead over to our website. Again, our website is www.optionsinfinity.com. Again, we're in our 10th year, 10-year anniversary. This is the home page. What I'd like you to do here on the home page is actually you can come up here and just take a look at the masterclass section. If you click on masterclass and you scroll down, you have an opportunity to learn how I actually do my trades. And these are all the master classes that you can purchase for a very reasonable sum. Now, what I'd like you to do right off the bat is take a look at this ultimate guide to entry and exit. This is something we put together. It's a blueprint of how I trade. It's $3. It's $3 to see exactly how I trade. So I think it would be in your best interest, if you like what you've seen, to find out exactly what it is that I do with the trades. Now, at the end of this video, you're going to be seeing a green circle with a D in it. That is that if you click on that, you become a subscriber to my YouTube channel. And there you can see a lot more of the educational videos that I've put together. And you know, I hope you enjoy those. I hope you begin your journey with me. And I look forward to helping you become a success in the arena of options. Thanks for listening. Bye-bye now.